Okay, thank you, Dorothy. Okay, Alfred and Vita, guess it's just us. The recording started. This is the part on ethical considerations and ethics. Now, if you are in any industry, law, accounting, banking, insurance, if you're with a advisory firm or whatever, you have some kind of a code of ethics or professional responsibility that you have to follow. And you should be used to it. And basically, a code of ethics is something that says, what are the guidelines that we want to follow? It's not necessarily, legally obligated to do this, but is it something that enhances your profession, gives you integrity, or enhances your integrity? And the CFP board is very, very, very cognizant of the need for this. The CFP board is really concerned about its code of conduct and ethical responsibility. And you as a candidate to become a certified financial planner have to follow the guidelines of the code of conduct. Now, what I'm also going to say is that the code itself is broken up into two systems, or two sections. One are the general principles, and the other one would be the rules. And as a candidate or as a financial planner, certified financial planner, you're obligated to follow the code and the scope and the intent. Now, you will find that there are 7 key words that you must memorize in order to be able to follow what's going on. 7 key words. And I've listed them separately. I'm going to give you some help for those because that's what's going to be tested. And you're not going to find the word honesty or ethical behavior or ethics listed in those 7 key words. What you are going to find are different ideas that make up those words. And it's something you have to aspire to. It's something that is a guideline and a principle. And it may not be something that would take you to court and you lose money over, but it is something where if you don't follow it, you risk being censured or losing the right to use the designation. A client is anybody that's going to engage you as a planner. A practitioner is anyone who is a certified financial planner. And it can also mean if you're dealing as a lawyer or a CPA or a trust officer, if you are a CFP, you have to also follow the ethical conduct requirements as a financial planner. As a financial planner, you will have conflicts of interest. There's just no way around it. In life, we all have conflicts of interest. But you have to at least disclose them and be clear to people what those conflicts are. You have to be aware of realizing even with a conflict of interest, your client's interest must come first, and you must disclose them. Let me give you an example of disclosing them. You recommend that client buys stock of International Widget Corporation for their retirement plan. You happen to own stock yourself. That doesn't mean it's a bad stock or a good stock. You have to disclose it. You may work for an insurance company that owns a stock brokerage firm or a stock brokerage firm that is owned by an insurance company. You may be recommending one of those products. You really have to let people know that there is a potential conflict because there is a mutual ownership here. Doesn't say you can't have it, just says you have to fully disclose it. Now, what are these key words I'm talking about? Integrity, objectivity, competency, fairness, confidentiality, and diligence. Just so you know, if you look at an older version of this, it might be called due care. Now I'm going to go through these words and explain them, and just so you know, we're going to probably get through slide number, somewhere around slide 50, We're going to get somewhere right up to slide 55 or 56. Okay. Now, what do we mean by, and you need to memorize these words. They're going to be tested, just so you know. There's 7 words. I don't want to put you back in 7th grade, but you need to memorize them. Integrity. What does it really mean? It means honesty. It means having candor, being very specific, putting the client's self-interest ahead of your own. Do not deceive people. Do not act in unprincipled manners. And make sure you disclose all conflicts and anything else. Just like I said, I don't take any referral fees from anybody I refer a client to. If I did, that would be something I'd have to disclose. Objectivity. Know what you know what you don't know. Be willing to bring in other people when you need them for help and rely on them. Disclose it. Make sure that you're not a one-size-fits-all for everybody where everybody gets the same exact investment. Competency. Well, making sure that you are educated in what you need to know and making sure that you fulfill all the education requirements as a certified financial planner under the requirements of the board. And making sure that you know the difference between being professional and being all-knowing and not. Now, again, if you're an attorney and you do estate planning, be my guest. You can hold out your shingle as a financial planner and an estate planner. But I don't think it's ethical to say I do estate planning and everything else if I'm not. And I personally don't think it's a good idea to get involved with some of these firms where they use you as a bird dog to go out and help people get a one-size-fits-all trust, because that's how you make money. Welcome back, Mary. Let me know if there's any problems you can hear me. Fairness. Fairness. Well, disclose conflicts of interest. Make sure that you realize there may be some conflicting interests between you and others and other professionals. Treat other people the way you want to be treated. Don't build yourself up by knocking other people down, especially if you're working with other professionals. Confidentiality. Always think of the old Dear Abby M. Landers, Ask Amy columns where people don't want their dirty laundry aired in public. Not a good idea. Make sure that if you're talking to people, you get full disclosure and permission. I even require, if I'm dealing with an accountant or a third-party administrator or a trust officer or an attorney, even if they referred me to the client or I referred the client to them, I still want something in writing that gives me permission to discuss the situation with them. That's also protecting myself. Professionalism, again, you want to have a credit to yourself and the profession. You want to report violations to the CFP board as well as other regulatory agencies. Be aware of the fact that if you're with a broker-dealer or a bank or an insurance company, you probably have a requirement that if there's a problem or something, you have to let them know first. So it doesn't say here that you have to disclose the, I don't know what just happened to my video. It doesn't say you have to disclose the, it doesn't say that you have to disclose to the CFP board first what's going on. It doesn't say that if you found out that someone in your office or your firm has done something that you don't think is right, you should go to the CFP board first. It does say you need to report it to the CFP board. If you get a test question or a quiz question and it starts asking you about going to the FPA chapter or going to your local CFP board, if there is one, that's not where you want to go. The CFP board has a national office in Washington, D.C., but you also may have to report things to FINRA, to the SEC, but you probably start with your own internal compliance department. And just so we know, what I'm saying for the exam is for the exam. If your own compliance department is a little stricter or has a different interpretation when you're doing stuff for that, go through it with them. Don't violate that. Use their rules and regulations. Professionalism says you're not going to have unfair competition, and you're not going to knock down other people to build yourself up. Diligence is real simple. Do what you say you're going to do in the time frame you say you're going to do it. Now, the next 10 or 12 slides speak specifically about rules. So if you look at integrity, it says don't solicit through misleading communications. Don't commingle funds between the planner and the client. Keep accurate records. Segregate client money and your money. Now, some of this makes common sense, but again, it's been put into the rules so you're aware of it. So rules dealing with integrity, again, you want to memorize these key words in the order they're there, because that's going to help you in the long run. Rules relating to objectivity. Suitability. Are you being objective? Are you making recommendations that are suitable for the client based upon what you know for the client? Have you looked at other alternatives? The fact that you're making a fee, the fact that you're getting a commission should have no bearing on what you're recommending to the client. That's not being objective. And also, putting everybody into the same investment, the same category, is also not being objective for the client. And that can get you in a lot of trouble. Competency. Well, it says you have to stay current, you have to stay informed about what's going on, but here, test question. It says every 2 years, every qualifying period, you need 30 hours of approved CE credit, of which 2 hours must be in ethics training. Now, if you go to the CFP website, it might say you need 28 hours plus 2. It means the same thing. Don't get hung up on the terminology. 2 hours of approved ethics training. Now, if you're an insurance agent, broker, producer in the state of Illinois, the law now says you need 3 hours of face-to-face classroom ethics training every reporting period. There are a couple vendors that will offer both the 2 hour and the 3 hours one course, and they've been approved for both. But either way, you still need to make sure you have the right amount of hours. If you happen to have other professions that require ethics training, they may or may not count for the CFP board, so please find out on your own. It further says that if you are not under competency, if you cannot do certain things, make sure you use other professionals. Fairness requires disclosure of any conflicts of interest, any new affiliations, locations, credentials, so anything that you have to do to update your information has to be disclosed. And if you are using a client for a reference to another client or you're a referral, you cannot disclose confidential information to that other client. There's 3 of you. Whoops, somebody just sent me an email. Give me a second to read it. Do you know if there's any specific type of disclosures that dual professionals must make? I believe, good question, I believe if you are, well, if you're an attorney or a CPA, your letterhead's going to say attorney or CPA. If you're specializing or doing somebody's financial plan and their estate plan, you're obviously qualified to do it. You still may want a disclosure saying that you're not giving, per se, tax advice, or they should still consult with their tax advisor. Usually in the different professional software packages, they have that kind of language. If you'll do me a favor, send me an email, and I will see if I can get an answer for you by next week if the CFP board has any specific language. No one's ever asked me that question. I think they do, but I'll have to verify it. Is that okay? Thank you. CFP, if you don't do what you're supposed to do, you can lose the right, or you have the right to be suspended to use the CFP mark. You can have it can be temporarily suspended for 30 days to a year. It can be revoked, and we're going to be talking about that a little bit later. So it's serious if you don't follow it. Again, confidentiality says make sure you get permission, make sure you keep people's information confidential. Please note it says you do not have attorney-client privilege because you're CFP. Excuse me 1 second. Thank you. Please note that the only time that you're allowed to break that confidentiality rule is if you are defending yourself either for prosecution or if someone's going to arbitration and filing a grievance against you, then you can use that confidential information. Otherwise, you need a court order or a subpoena that you are releasing it. That means from the police department. I mean, a lot of us have watched NYPD Blue or Law and Order, and even if they're investigating a murder down the street, doesn't give you the right to release confidential information. The IRS, walking in the office, unless they have a court order, and this might be a trick question, even the IRS still needs something from the court for you to release the information. The exception is if you're defending yourself or if the client has given you permission. It says again, professionalism, you have to inform the CFP board, but it also means you may have to inform your own professional advisors, your own professional compliance department and or regulators. Okay, now, this is going to be highly tested. It's tested on the comprehensive exam and it might be tested on a registration exam. You are not allowed to use the initials RIA or IAR next to your name. You have to spell out registered investment advisor or investment advisor representative. That is in the Code of Conduct for Professional Responsibility and the 1940 Investment Advisor Act. Now, you can say you're a CPA. You can put CFP if you use the registered trademark, but you must spell out registered investment advisor. And there's some slides that will show that later on. Diligence, again, you have to fully disclose everything, you have to refer to other professionals, and you have to do what you say you're going to do in the period of time you say you're going to do it. As a study tip, I told you you need to learn these 7 key words. So, what I learned was I only call for Chicago Police Department. It sounds stupid, but when you're taking an exam, you may need that as a study tip. If you lived in Cleveland, it could have been the Cleveland Police Department. You can make up your own. But if you notice, it's in the exact same order. One of my colleagues likes, I only can find colored paper, damn it. Somebody else actually reformatted the words saying that I'm studying to become a certified financial planner, which I don't like because I want those words in the same order. By having the words in the order that they're listed, it relates to the rules and the numbers of the rules if you ever have to look at them, so you don't have to memorize everything. The old rules, number 608, under professionalism, actually quoted from the Investment Advisor Act of 1940. So that goes to show you how important that can be. Tested, highly tested. How are you allowed to use the marks? Now, I know if you're pretty bright people, you're going to say, you can look this up, why do you need to memorize it? Because you do. There's actually on other content, there's a little booklet that has the CFP Code of Conduct and Professional Responsibility. There's another link to this booklet on proper use of the marks. You will notice CFP is all in capital letters with no periods between the letters. And there's a registered trademark, or you can use the TM for trademark. Certified Financial Planner is spelled out as always in capital letters. However, you are not a Certified Financial Planner. That is a registered trademark. You must always show it, which is why below it says planner or practitioner, professional practitioner. You notice that the Certified Financial Planner part is in capital letters and the practitioner or professional is in uppercase and lowercase. If you happen to be a certified financial planner and an investment advisor representative or a registered investment advisor, you would spell out both together. If you violate the code, again, you could get a private censure. Don't do it anymore. You could get a public censure or admonition which says they're going to publish it in a newspaper. You could get a suspension or a permanent revocation. Be aware of the fact that if you lived in Podunk, Utah, they might publish the letter in the newspaper. In Chicago, they're probably not going to. Tell me if I'm going too fast for you guys, because I don't know. Practice standards centered around the financial planning process rather than your moral conduct. Each series of the financial planning process is coordinated with one of the steps. So the practice standards, series 100, 200, 300, 400, 500, 600, will follow, establish the relationship, gather the data, and so forth. Please be aware of the fact that the requirements are outlined in that booklet, and they are enforced by the Certified Financial Planning Board of Standards. I am not going to read every one of these to you, because this is repetitive and redundant from what we went over before. I do want to have some discussions here. And it says, although the Advisors Act and Code require written engagement, the client may not be required to sign it. I will tell you that the firm I'm with, the client is required to sign it. That's where the firm and the CFP board differ. Furthermore, my letter of engagement will spell out how I'm getting paid, spells out what I want to do, what is going to be included. That's all part of this. Now, it says, do I want to engage in illegal activities? No, I don't even want to have a client that says, I'm willing to even go to jail to avoid paying taxes. There's too much liability, and I don't want to deal with people like that. If you are dealing with Jack and Jill, and they both engage you as their planner, and they get divorced, you may have to recuse yourself and not be either's planner. It says here that if the planner does not foster, you can't foster concealment between the spouses. So if you're both engaged to do a financial plan, you cannot really, only give information to one of them. And you may have to, if they get divorced, the smartest thing might be just to say goodbye to both of them, unless they both agree that you can serve one of them. What are your goals and needs? Gee, this is the second step of the process, gathering the data. How do you find out stuff? What do you need to know? Again, very basic information here. Standard number 3, analyzing. That's the third step. There is a reason that you want to memorize the 7 key words for the ethical behavior in the order they're there, and understand that the practice standards, series 100, 200, 300, 400, 500, 600, mirror the 6 steps of the financial planning process. Now, Mary, Elfwood, and Beta, you're online right now. If you have questions, ask them. If not, I'm going to continue to go through these pretty quickly because it's redundant to what we just covered. Communication is very, very important. You have to be able to put together a plan and then explain the plan. You have to be able to communicate both verbally and in writing in a narrative form. You have to be able to make sure you're clear and concise and that people can understand what you're doing. This is not where you want to show off and make sure that people think you're really smart and you can use 75-cent words when a nickel word will work, and you all know what I mean by that. If you can't effectively communicate what you're doing and the plan to people, then you really have a problem. So be aware of that. Series 500, implementing the plan. Will you manage the investments? Will you outsource that? Will you handle the people's insurance? Will you outsource that? Are you an estate planning attorney? Do you outsource that? Are you a CPA or an enrolled agent or a tax advisor? Do you outsource that? What do you do, what don't you do, and you should spell it out. When you're doing a comprehensive financial plan, make sure you know what you're doing, and if you're not really comfortable talking to somebody about their homeowner's insurance or their will or trust, make sure you deal with the right professional so you know what you're doing. I am doing right now a financial plan for a widow, and I've read over the trust agreement. and I have a couple questions. Now, I could interpret it myself, but I have asked the client to please contact the attorney to see if I can discuss some things with the attorney to ask a couple questions, because I'm just not sure how a certain section is worded, whether it's going to allow me to make the trust the beneficiary of something, or if I'm better off having the individual children as the beneficiary of the IRA, because the wording isn't clear to me. Well, why am I doing that? Because there's tax reasons involved, and that's my job. My job is to help the client understand everything I can possibly help them understand regarding their finances, their insurance. If I'm not comfortable talking about property casualty insurance, I will bring in somebody else. Practice Standards number 600 talks about monitoring, and someone asked about the frequency of monitoring earlier. As I said, I've given you that information, but it should be at least once a year. Now, this may sound as a pretty simple thing, and it says don't borrow or lend between the planner and the client. Hello? The only exception to that is if the firm you're with is a bank or a stock firm or broker-dealer where their normal business activity is lending money. Then it's not you that's doing the lending or the borrowing, it's the entity. When you do that, you're lending or borrowing money or going into a venture with a client, you are opening yourself up to all kinds of conflicts of interest and unethical behavior. There is a great deal of controversy today in terms of how people want to conduct their business. Are they fee only? And fee only means you only accept a fee, whether it's hourly, a percentage, a performance-based fee, which may or may not be restricted under the Investment Advisor Act. It might be an there's certain if they're inconsequential or de minimis, where people, like a wholesaler takes you to lunch, or maybe you're going to get golf shirts or something. That's not really a big deal, but if you're getting invited to the Super Bowl that's going to cost $5,000 for transportation and the ticket, that might be considered something you should be disclosing, and it might even be unethical. If your business model is fee only, remember that thing that says near the bottom, you can only accept a fee. That means you don't accept any kind of commissions. Now, what do we mean by the business model? For the comprehensive exam and for the quizzes in this class, you need to understand a fee only is fee only. Fee-based would be you accept a fee for maybe investments under management, you accept a fee for maybe doing a financial plan, but you may also accept commissions. Commission only means you only take commissions. I will tell you that I have met people that are 100% ethical that are only on commission. I have met people that I believe to be unethical that are fee only. So the business model that you choose to work under does not guarantee whether you are going to be fee only or not. I mean, whether you're going to be ethical or not. It does guarantee that you need to be aware of it. And if you get a test question, fee only means you're only accepting fees for money under management or for doing a financial plan or doing advisory work. It does not mean you're taking any kind of commission or any other kind of financial incentive. I'm on slide 33, going to slide 34 of chapter 2. Now, question. What does it mean under the investment advisor regulations? Why is that important? Well, let me give you some quick background. After the crash of 1927, Congress, in its infinite wisdom, decided that it was time to update things for protecting the public. So in 1933, they came out with the Security Act of 33 that deals with paper and what should be listed on the prospectus documents so people can understand what they're getting and how much risk. In 1934, they came out with the Investment Act that dealt with people, registrations, and that's where they actually enacted the Securities and Exchange Commission, was the Act of 1934. 1934, even though it's mentioned in the Act of 33. In 1939, they came out with a Bond and Debenture Act so they could more accurately define debt instruments. In 1940, there was the Investment Company Act that deals mainly with investment companies and mutual funds, and the Investment Advisor Act that deals with people and what they need to know. And then in the 1960s and 70s and all the way up to now, they've had all kinds of amendments to these, the Anti-Money Laundering Act, the anti-fraud provisions, and so forth. You don't have to memorize them all, but you do have to be aware of the fact that regulators today, between the SEC, which is a governmental agency, and FINRA, which is a quasi-governmental agency, work together to protect the public interest. You also have to be aware of the fact that Dodd-Frank in 2010 did a lot to try to bring things up to the current level. That the Anti-Money Laundering Act was to protect the public against, truthfully, illegal uses of money and money manipulation. So the Investment Advisor Regulation says, what defines an investment advisor? Well, if you go on Google and look up security, what's defined as security, you're going to see that a security is very broadly defined as any debt instrument, equity instrument, limited partnership, certificate of deposit, investment program, where you have a chance of making a profit, and it's very broadly defined. You also have a chance of losing money. So the first thing it says is, if you're an investment advisor, you have to pass the three-prong test. All three prongs of this test must be fulfilled. And it's saying, sometimes, what does it mean? It says that all three have to be met, and this is sometimes referred to as the ABC rule. ABC rule. Are you giving advice or analysis on securities as a business standard, is it your business, for some form of compensation? ABC, advice or analysis concerning securities for compensation. First, that's the question. So if you are doing incidental advisory work, you don't have to worry about being registered. But if your primary business and you hold yourself out as an advisor, giving advice and or analysis regarding securities for compensation, then you may have to register as an investment advisor at the federal level or at least at the state level. Furthermore, please be aware of the fact that if you are an advisor under the Dodd-Frank regulations, things have changed a little bit, and we're going to discuss that. You are going to be tested on phase-ins and phase-outs of tax rules for Roth IRAs, and you might be tested on what is required to be registered at the federal level as an investment advisor. I'm not asking you to memorize them all because they change sometimes frequently, but be aware of them. Now, as an investment advisor, it says, are you giving advice or analysis or making reports on securities, which is broadly defined, as a business standard? Either you're an advisor, a manager for portfolios, a planner, a pension fund manager. Are you doing that as a business standard for compensation? If, let's assume for a minute, you are an electrician working for Howard's Electrical Contracting Firm, and I have 150 employees. And you talk to all my employees, and you're an electrician, and at lunch, you're bragging about how well you've done on your 401k management, and you're beating the averages, and where people in 2007, 8, and 9 lost 50%, you were up. And your friends are all saying, can you help me? And you're more than willing to help them. And every once in a while, they even pay you by giving you lunch or tickets to the White Sox or Cubs games. The fact that you're an electrician, it's not your business, you don't have to register. But if you happen to have 50 clients, and you may have to. So understand you have to look at what the intent is, and you have to be aware of what you're looking at. If you're with a firm that offers a wrap account, which means they're taking a fee as opposed to a commission, you still may be, if you're with the firm, you still may not have to necessarily register, depending on how the firm works. That was the old Merrill Lynch rule. I'm only bringing this up right now because you need to know what a wrap account is, and it says that's where you're paying a quarterly fee for the advice management transaction. But if you're a stockbroker or registered representative, you may not have to necessarily register as an advisor. If, on the other hand, you fall under an exception. Now, if you're taking a registration exam for the Securities and Exchange Commission or FINRA, a Series 6, 7, or 65, 66, this will be tested, the difference between an exception and an exemption. If you are not taking that exam, you have to have a broad understanding of this, and there will be a couple quiz questions on these slides. Speaking of the quiz, quiz number 1 is due after we finish all of Unit 1. So it's not due until after Wednesday night. And you will have 2 chances on quiz 1 to get the answers right. After that, you get 1 chance, and it's about a half hour per quiz. Now, it says here there are exceptions to registering as an advisor. If you work for or are a part of a bank or a bank holding company, that was never the intent of the law for you to have to register, we have an exception. If you are a lawyer, accountant, engineer, or teacher where giving that advice is incidental to your profession, you don't have to register. Now, let me explain in a little more detail what I mean here, because this one is tested highly. On your notepad, change the order and make it late. Lawyer, accountant, teacher, engineer. Why is it listed this way if I wanted to do it another way? Because the law says lawyer, accountant, engineer, or teacher, but if you think of late as an exception, it might help you on a test question. Jack and Jill come to you as an attorney wanting you to review documents for a limited partnership or a general partnership they're going into. So you're giving them advice on the legal aspect. You also may mention, are you aware of the fact that as a general partner you have this kind of liability, as a limited partner you have that? Are you aware of these things? Is this really what you want to do? The investment advice is incidental. You're a CPA and they come to you to see, does this make sense on a tax basis? Your investment advice is incidental. You are a civil, structural, or geological engineer, and people come to you to see if they can build this high-rise building, are there minerals underground, or whatever. Again, the investment advice is incidental. Teaching at DePaul University in this program, I can give you all kinds of advice based upon all kinds of things, but it's incidental to what I'm teaching. If I walk out of the classroom and call one of you up to become your financial advisor and you're one of my 100 clients, I may have to be registered because I take off the teacher hat and put on my professional hat. Be aware of the fact, read questions carefully. I want to take a deep breath. If anybody has any questions on this one, I would like to see them. If not, let me know one way or the other. If you have a question, I want to make sure you understand this as an exception. Any questions? Okay, good. If the broker-dealer is not charging any management fees, and all I'm doing is getting paid through commissions, I have an exception. If I work for Investors Business Daily, Fortune Magazine, Forbes, Newsweek, the Chicago Tribune, and I'm a reporter or write articles and things on finance and investments, that's an exception. If I own my own column or I'm with a private newsletter, I may have to register. If everything I do is just giving advice regarding U.S. Treasury securities, it's an exception because up until 18 months ago, the U.S. Treasury securities was considered to be what? AAA rated with no risk. So that's where it's at. That's an exception. There are 3 exemptions. You have to understand the difference for a licensing or registration exam between exception and exemption. There are 3 of them. If all of your clients, all the advice, and all of the investments are intrastate, they're all in the state of Illinois, that's an exception. If you're serving insurance companies only, they were considered professional in 1940, that's an exception. If you don't hold yourself out to the general public and only have a limited number of clients every year, that's an exception. So be aware there are 6 exceptions and 3 exemptions. Now, this may be a little bit different in your textbook because I'm not sure the textbook picked this up since 2010 when the Dodd-Frank regulations came into being. But what this is saying is, number one, if you have less than $100 million under management, you now will register with your state. If you have over $100 million, you register with the federal government, the Securities and Exchange Commission, not FINRA, but the SEC. You have to file certain forms. The ADV, which stands for advisory, Part 1, Part 2, and Part 2B. It used to be that you had to offer those forms to a client once a year after they became your client. Now you're obligated to mail it to them and update any substantial changes. Don't worry about the filing fees. It's not going to be tested. They're here so you're aware of it. Be fully aware that under the ADV you must maintain your records for 5 years from the date of the last entry. Now that means even if the client died or if you left being an advisor, you still must maintain it, and some firms will require you to do it for 6 or 7 years. The firm I'm with requires 6 years as a minimum, but for the exam you need 5 years. You need to understand that. The ADV Part W, there actually was a test question one year that asked what that meant. It means you are withdrawing as an advisor, but you're still obligated to maintain the records for a minimum of 5 years. And if I remember correctly, it's 2 years physically on site and then 3 years reasonably accessible. The next couple slides explains what should be included in this advisory form. Some people just give photocopies of what you file with the government to their clients and prospects. Other people have, colored pictures and 6 colors, glossy paper. As long as you have all the information, that's all anybody cares about. What's the background? What is your licenses? What are your associations? What is your business entity? How do you do things? That's about the firm. On the Part 2, you go into more detail. What's your strategy? How do you determine what you're going to do? How do you determine who your new clients are going to be? Do you take limited power of attorney, which means you have discretion? Part 2B, this is where you talk about yourself, and the regulation says it has to be in plain, simple English in a narrative form with a table of contents. You have to disclose any material changes. What is your business? How are you compensated? What is your educational background? If you are a certified financial planner and have designations, what did you have to do in order to get those designations? What's your experience? Have you had any disciplinary actions? What's your outside business activity situation? Who is your supervisor? How do you determine what you're doing? What's your methodology? All of these have to be disclosed in a certain order with a table of contents. What is your fees? How do you get a fee? Clients must have a minimum net worth of $1.5 million, and you must be managing $750,000 of their money if you're having what's called a performance-based fee. Who's allowed to use performance-based fees? It says if the client's a registered investment company, that means if your client runs a mutual fund with an investment company, you can charge them a performance-based fee, but the performance must be based upon some kind of a standard. It has to be based upon a standard of care. Did I beat the S&P 500? Please understand you need to know the difference between a suitability standard and a fiduciary standard. My understanding, and I'm not an attorney, is that Black's Law Dictionary says a fiduciary says that relationships exists where one person trusts and relies upon another, or confidence is on one side and domination based upon knowledge and influence is on the other. An investment advisor does have a fiduciary standard to operate under the utmost good faith with full fair disclosure of any conflicts, and always put the interest of the client first, and all recommendations should not only have their interests be suitable, but also have their interest first. I need another few minutes and then we're going to be done for tonight. You have to give the client 48 hours in advance your brochure with all this information before they sign anything. They have to have 5 days right to rescind it. And all updates must be provided within 90 days at the close of your year, and that's under the Dodd-Frank Act. Who registers? Real quickly. If you have over $100 million under management, register with the federal government, and you're called a federal advisor. Under $100 million, you'll probably register with your state, except in a few exceptions, which I have on the slides. You're not going to be tested on those exceptions. What's the difference between an investment advisor, a registered investment advisor, and an investment advisor representative? It's basically, are you the firm, do you own the firm, or are you working under a firm? I was about to become my own firm and then decided for compliance reasons and to make my life easier, I was going to go under somebody else's umbrella, which means I'm an investment advisor representative. My investment client contracts are personal service contracts between me and the client. I cannot force a client to work with somebody else. This is, again, what are you allowed to put on your business card, on your letterhead? It says how it must be spelled out. And again, I want to show you, there's a slide, how to use the marks. Jack D. Planner, CFP registered trademark. You want to spell it out. Here's how you do it. Registered representative, investment advisor representative. This booklet is on the website under content. So it's already there. Prior to taking your comprehensive exam, make sure you review it because that information is going to be tested. Okay. What's the correct answer here to the people in the classroom? Anybody give me an answer? B is the correct answer, and it looks like all three of you got it. I thank you very much. And this is where I'm going to stop tonight, and we will pick this up next Monday. Are there any questions? I said we'd be done by 9 o'clock. I was pretty close. Are there any questions tonight? I'd like to thank you for coming back to this class. You've now taken care of the whole first week. I will probably be sending everybody an email with some other updates. I do apologize for the technical issue earlier. I'm going to stick around in case anybody has any questions.